Hello and welcome to a new episode of Macro 2.0. With me today, as always, is Barry Nielsen, Chartered Financial Analyst from Opportunity Bank. Welcome back.
Thank you.
We're on our 6th episode today, so we're making progress through these big ideas, big institutions, and talking about big money. And today we're going to address the stock market, something that most of us hear about every day. We watch it on the news, it's in the newspaper. Lots of information about the stock market, but I'm going to be the first to admit here that most of what I hear and see, I don't interpret or digest very well. I'm just not very well versed in the structure and the function of the stock market. So your task today, your mission, should you decide to accept it, is to kind of give us all a crash course in the stock market, or just certain aspects of it that are meaningful to everybody who's in America. So to begin with, going back to the daily deluge of news, there's always something about stock indices. We hear about the Dow, we hear about the S&P 500 and the NASDAQ, and on a day-to-day basis, one of them's up and the other's down, or they're all up or they're all down. But I guess this is a real basic question. What are those stock indices, and what function do they fulfill in terms of monitoring or providing information about the health of the market?
Yeah, you mentioned three indices, fairly well known or very well known and widely followed indices. There's multiple indices that cover all different sectors of the stock market, from, for example, the NASDAQ 100. There's a semiconductor index, there's a transportation index, there's sub-indices or sub-indexes of all the major indices. And they provide investors a gauge as to how the overall market is performing on a daily basis, or certain sectors of the market, subsectors of the market. And those indices are constructed in different ways. They represent the price movement of the individual stocks or equities that are part of each one of those indices. Some indices are equally weighted, meaning that each stock in the index receives an equal weighting in terms of price movement. Some of those indices are what we call market cap weighted, or market capitalization weighted, meaning stocks with a larger market capitalization, which is the share price times the number of shares. So, for example, I think Apple is at this point, the world's largest market capitalization. Their number of shares times the price of Apple is greater than any other stock in the world. I could be wrong, but I think that's true. So, to answer your question, the different indices are there to provide a gauge of market direction on any given day or over a period of time, the prior week, year, 10-year return, averages, just a gauge of stock market direction.
Yeah. So let's talk a little bit about what drives the prices of stocks. You know, a stock is a share of ownership in a company, and people buy stocks. Rarely do they buy a single share. They're mostly blocks of shares. But what is it that drives prices up? Not for an individual company, but let's say we're looking at an index, and it's sort of a pattern that's seemingly predictable for a while. Let's say it's going up. What is it that drives stock prices up? We're talking about the macro economy. I'm sure there's a lot of factors at play, but there's probably some major ones that you would point to.
Well, I think the correct answer to your question is we don't know. Because if we did, you and I would both be millionaires, billionaires. But in general, it is economic activity. I mean, there's this individual success of a corporation that certainly impacts the share price of that corporation. But in general, it's the strength of the economy. And then investor behavior. And really, I think an important point is that markets, particularly the stock market, is very forward-looking. So the stock market, in many ways, reflects the consensus view. And again, when we talk about the market in general, the broad index, for example, the S&P 500, we'll say, which is a broad index, its performance largely reflects investors' view, and I like to call it a consensus view because it's millions, tens of millions, 100 million different individual investors all expressing their view of the economy at a macro level and at an individual company level, their view of that company's future prospects, that company's future earnings, which, again, there's certainly management decisions that are part of that and a number of other things that are company specific, but the strength of the overall economy certainly plays a large role in that. And again, it's important to know that it's very logical and rational to think that therefore the stock market is forward-looking. What does it think of the strength of the economy and policy and interest rates and a number of other things that impact the value of stocks that happen on a daily basis. And therefore, if we get a negative news story, that therefore the stock market generally is going to react negatively. And then I also think it's important to note that we live in a very in the Federal Reserve's own words, extraordinary time period where coming out of the great financial crisis, we'll say 9-10 years ago, the Federal Reserve had a stated goal of driving investor behavior and driving money into risky assets. And stocks are considered a risky asset as opposed to...
Yeah, compared with other...
That's right. For example,
compared with cash?
Absolutely. Or we might even say U.S. Treasury bonds.
Yeah.
That was part of their stated goal. And in fact, they named it. They called it the Portfolio Balance Channel Strategy. And so, at least in my view, quantitative easing, which I think we've talked about a little bit in the past, where the Fed bought trillions of dollars worth of U.S. Treasury bonds and mortgage-backed securities. They literally printed money in doing so. That money went somewhere. Some of it might have gone into housing. Some of it certainly went into bonds themselves. And I think that a lot of that money went into stocks. So I just use that as an example. We'd like to think that it's what we call fundamentals drive stock prices, a fundamental view of the economy, the strength of the economy, where we are in the business cycle. That certainly plays a big role. Yeah. But there's a lot of other factors that are driving stock prices as well. It might be what we call corporate buybacks, corporations that buy back their own shares. They might even issue debt to do that. When they do that, they seek to enhance investor value on an individual share basis. In other words, they retire a number of shares, which theoretically should drive the price of those remaining shares higher.
Yeah.
There's a lot of things at play there. And so, again, if
a complicated situation.
We knew the answer to that question, you and I would probably not be here today.
Yeah. Well, here we are stuck in partial ignorance anyway, at least on my part. Well, I'm glad there's two things you mentioned. One is that the share buyback behavior of investors, this is another subject for another day, but one of the consequences of the tax bill, the recent tax bill overhaul of corporate taxes, there was an expectation that would lead to a lot of capital investment, and it may indeed do that in time, but in the near term, a lot of that tax relief went straight into buying back shares in the big corporations. But that's an aside. You also brought in the Federal Reserve, and I'm glad you did because it's an example of how policy, public policy, is a major component of, or major one factor among all these other behavioral factors, market-driven factors, but government plays a role in that. And my sense in your explanation is that there was a deliberate attempt to enhance the public's confidence in the future. You know, they're enhancing people's expectations that the economy will improve, and that will be manifested in a rising stock market. You know, everything is going upward. And that leads me to a different channel of thought, but we talked about a little bit before the show began.
Can I just add one thing there?
Absolutely.
You're absolutely right. I mean, investor confidence, that is huge. Part of a stock market, share prices, the S&P 500 and all the other different indices. And there are, in fact, indices out there to measure investor confidence. For example, the University of Michigan Consumer Confidence Index. That's a very widely watched index that measures consumer confidence on a number of different levels. And that alone will impact stock price direction on the day that index is released. Investor confidence, again, because that's a forward-looking measure, that is a huge part of share prices.
Yeah, well, if I put this, there might be an imprecise way to put this, but some people have too much confidence. Some of this activity, quantitative easing, could even lead to overconfidence, and that results in stocks being overvalued. This is something I read about again, and don't quite comprehend. Well, okay, who's to say whether a stock or an index itself is overvalued? You know, compared to what? So you're in this business, and I'm sure you have a lot of experience thinking about coming with an opinion as to which stocks, not shares, but which companies may be overvalued. And I'm thinking in my head right now that there are companies, very large companies that people are familiar with. I don't need to name names, but they're actually unprofitable. You know, they haven't really made a dollar of profit, and yet the value of their stock is sky high. And that has to be based on some sense of expectation that in the future, yeah, they're going to turn this mega machine into a profitable machine. But in your own view, how is it that stocks can become overvalued or undervalued on the other side?
Well, again, if I knew the exact answer to that, I'd be sitting on my private island, I promise you. But there are fundamental measures of value, something called price to earnings ratio, for example, which is the share price divided by the company's earnings. And that can be measured as a whole in aggregate on, for example, the S&P 500 at the index level, stock index level. Price to sales ratios. Those are all fundamental measures of value. And we can look at those ratios today versus past stock market episodes, for example, 2000, the technology bubble, or heading into the great financial crisis. And we can form a view as to whether stocks are, we might say, fairly priced by historical benchmark or overvalued by historical measures. Or undervalued, but again, it's really investor psychology. It's a view of the future. I mean, ultimately, a share's price is worth only what the company is going to return to the shareholder over time. The present value of future earnings of that company, and plus, as a shareholder, and you have an equity stake in the company, so you have some claim on the assets of the company. But again, but even those could be thought of as a future cash flow, or if the assets were sold. So it's very forward looking, and it's only worth what people think it's worth. And it may be as you say, there's companies that have no current earnings. But investors think that the future is so bright that at some point in the near future, or maybe even distant future, they're going to have tremendous earnings. For example, biotechnology companies, those might be a good example because they're in the development process and they haven't made a cent off of a drug that they're currently developing. But at some point, it might be cancer related, help towards a cure in cancer. And
so that massive amount of investment is a signal to a shareholder that sooner or later it's going to result in a profitable product.
Well, we don't know that, but somebody thinks
it's a belief.
It's a belief.
An expectation.
That's right.
You did mention the word bubble, and we are always running short of time, and I want to get to one other subject, which is how many people are actually invested in the stock market. But let's just spend a couple minutes on a bubble, because as I understand it, bubbles, there's many historical instances where certain sectors of the economy become overvalued. People have expectations that in the end prove to be unsustainable, or something is found out, and the market in that sector, housing or tulips way back when, crashes and people lose a lot of money. Can you just say a word or two about bubbles and how they happen and how they pop?
Well, it probably is irrational emotional behavior, and we're all guilty of it. I mean, you mentioned the Dutch tulip bulb bubble. That's one of the most famous ones in history, where I think it was in the mid-1600s, people were spending a year's worth of wages or salary on a single tulip bulb. And the technology stock bubble, where companies that, some of them survived, there's a number that have gone by the wayside, that people were just throwing money at anything because the future was so bright in technology and the internet and networking and whatever. So a bubble is not a bubble, I guess, until it bursts, and then everybody knows it's a bubble. It's very hard to know when you're in a bubble.
So that's the not forward-looking aspect of the stock market, is when a bubble pops, you look back and go, oh my gosh,
that was a bubble.
And I was in it. Well, in the few minutes that we have remaining, this is a big subject, so I'm sorry we don't have more time to deal with it. But I have some figures here about referencing economic inequality, which is a huge issue in our economy and in the world. But there's some interesting figures about the stock market itself. Basically, the proportion of stock owned in the U.S. most of it is owned by a tiny minority of the population. Okay. Well, nearly half of Americans have investments of some sort, mainly through mutual funds, trusts, and pensions. Some 85% of stocks are in the hands of the richest 10% of the people. Is this something we should be concerned about? I mean, I can speak for myself. I have tiny pension investments that are handled happily by a company, a management company, and my wife has a 401k. I mean, we're typical middle-class Montanans, so we have investments in the stock market. We don't pay much attention to them because we leave that to experts. But what's disturbing to me, or concerning, I should say, is that the vast majority of the value in the stock market, the equity ownership, resides in the hands of a very, very concentrated group of people. So when the stock market goes up, it means a lot to them, and it doesn't really mean much to me. But is this an economic problem that needs to be addressed, and how might we address that?
Yeah, I don't think it's so much a problem with the stock market as it is with the economy in general, the income gap, the wealth gap. But I think you're right, and I don't know the answer to that. That is something that is of concern. It seemingly continues to increase. It's certainly a function of at least partly a function of government policy, but I don't know that I certainly don't have all the answers to that, and I don't think we have time to discuss that. Yeah. But that's a problem. But as you note, I think a higher percentage of people today own stocks than ever before in their 401k plans at work, in an IRA or other type of retirement plan. And they really should be paying attention to the economy and the market, and they should know how their retirement funds are invested, and they should self-educate themselves on have some knowledge of portfolio and risk management, and speak with a well-qualified investment advisor and get a good advice, but also be part of that. Just don't take it passively, but form their own views and opinions and have some knowledge. And with the internet, you can do that so easily. There's so many sources and so many articles available to spend 10 minutes a day, 5 minutes a day, just reading on what a price to earnings ratio means, or diversification, or future value, present value. Those are easily understood. You don't have to have a PhD in finance to do that, but it's your own retirement, and you can leave it to professionals, and you should certainly seek the help of professionals. But I would highly recommend and suggest that you self-educate yourself and have a view and an opinion that you can discuss with your investment advisor, and bounce ideas off of him or her, and have him or her provide advice to you. And so it's really an educated decision, because it's such a big decision.
Yeah, that's a good way to end this episode. And I have to say, you've been really good about that kind of general advice through your columns. I want to make reference to these columns because that's what's gotten me more and more interested in being something other than a passive investor, even at the smallest level. So thanks again for being with us. Next week we'll address a sector that you're very involved with, and that's bonds. Stocks, then bonds, and then we'll proceed on to other subjects. So thanks for watching Macro 2.0. Join us again for the next episode.